Welcome to the InterMarket Analysis video update. This video attempts to look at other markets not only within the stock market, but also outside of the stock market to get some insight as to what's happening within the S&P 500. This is being prepared for Monday, April 3rd. The first area we look at is valuation. You can see on this chart that there are three lines, a red, blue, and green. This measures the valuation of the market on a historical basis. The red line is a PE ratio of 20. PE is the price to earnings ratio. When we're at 20 or above, the market is considered to be expensive. When we're at a PE ratio of 15, the blue line, the market is considered to be fairly priced. And when we reach a PE of 10, that's the green line, the market is considered to be inexpensive or cheap. On this chart, you see where the S&P 500 is above the red line. Down below, that measures the distance from the S&P price to the PE ratio of 20. When we're above 0, the market is considered to be expensive on a trailing 12-month basis. Another chart shows the valuations over time going back to 1980 and different events that have happened and the valuations at those levels. We also look at valuation using the Shiller PE ratio, which calculates things in a different way and takes an average over a period of time. Right now, we have a PE ratio of 29.3. Historically, between 16 and 17 is about the average price. So this would also suggest that on a trailing basis, the market is considered to be expensive. But the markets don't use trailing information. They use forward-looking information. This chart looks at the forward PE ratios for the S&P 500. As of Friday, we have a PE ratio of 18.1. We're below 20, but above 15, so the market is just a little bit pricey right now in that regard. There's also a lot of debate going back and forth because analysts are projecting higher earnings going forward, where the economy suggests that there will be a slowing down of earnings, and this can be adjusted at any time. Looking at the mid-caps, we have a PE ratio of 13.6. We're under that 15 level, so mid-cap stocks are a little inexpensive. And the small caps currently have a forward-looking PE ratio of 13, again, in between that 10 mark of being inexpensive, but yet underneath the 15 mark of being fairly priced. And these adjust every day as prices go up and down and as earnings forecasts are adjusted. Another area we look at is growth versus value. This is a growth index showing that we're in an overall downtrend. We have the 50-period moving average below the 200-period moving average. We look at value, where value is still in an overall uptrend, but it has been really coming down lately. We compare the two. Growth versus value is on the top, where growth is still in an overall downtrend, even though it's improving. On the bottom, value is in an overall uptrend, even though it's been showing some weakness. Then we look at a series of charts measuring growth versus value, where growth is still in an overall downtrend compared to value, but it is showing some improvement. Here's an inverse of that same chart showing how value has been outperforming, but showing some weakness. We look at ETFs, also showing that growth is underperforming, but bouncing back. And here, value is still in an uptrend, but showing some weakness. And then the last chart also shows indexes where growth has been underperforming value, but showing some improvement. Some other areas that we look at, on the top we have the NYSE Common Stock Advanced Decline line. When we're going back above the moving average, that is more positive. Then we look at the S&P, which is also turning more positive above the moving average. Mid caps are also showing improvement, but small caps are lagging a little bit. They're still right on the moving average. We look at the 30 biggest software companies, which gave us a recent golden cross and have been showing some nice strength as of late. We also look at inflation against deflation. When we're below this moving average, that means we're in a deflationary environment, even though it has been ticking up. If you look at the red line, you notice that it is also declining overall. So that means inflation is starting to subside. We want to keep an eye on that because too much deflation could be very negative for the markets and the economy. Baltic Dry Index, how much does it cost to ship goods from point A to point B? We're in an overall downtrend, but it has been coming up as of late. Tom McClellan has posted some additional charts by taking the Baltic Dry Index and then putting it forward 26 days, and he can see a pretty good correlation between the two. Where the Baltic Dry Index had been coming down, it seemed to have bottomed out, and it's been coming back up. That could give some support to the S&P 500. Here's another look at that same idea. Doesn't mean that this relationship is perfect. There are times when the correlation does invert, but lately, as this has been coming back up and declining just a little bit, that has been giving some support to the S&P. Another area we look at is the CRB index. When commodities are going up, that's inflationary. Lately, we saw a recent death cross and an overall downtrend, but this past week, the CRB index did bounce back up to its 50-period moving average. Then we look at a number of different commodities. Corn, which had really spiked up, has been coming back down. Aluminum has also been falling down a bit. Heating oil has also been retracing, as has gas, even though it's ticked up slightly over the past week. Natural gas, which went all the way up to 10, came down to 2, is bouncing up just a little bit. Oil has kind of been between 75 and 80, where right now we're at 75.67, and earlier in the week we actually dropped below 70. We also check out diesel, and over a period of time, diesel prices have been coming down. Wheat has also been coming down. Fertilizer has also been declining. Lumber has been in a decline. The dollar has also been in a downtrend after giving a death cross and has been falling back from recent highs. The euro is in an uptrend compared to the US dollar, and the Japanese yen is also in an overall uptrend. Here are individual charts showing how the British pound is in an uptrend, and here is the Japanese yen also in an uptrend compared to the dollar. Copper is still in an overall uptrend, but it's been pretty much chopping sideways. We keep a close eye on copper since it's a barometer of the economy. When copper's going up, that's usually better for the economy going forward. When it's going down, just the reverse of that. The copper to gold ratio, gold's been really doing quite well lately, so copper has been starting to underperform. Here's a longer look at that same chart compared to the 2-year yield, where there's a really wide spread between the two. Even though the 2-year yield has been coming down, the copper to gold ratio has also been declining lately, where these tend to move in the overall same direction in a good healthy environment, and they tend to not get too far apart from each other even though they're on different scales. Gold is in an overall uptrend, and people that really like gold are quite excited right now. Silver has also been performing well lately. Then looking at some other indexes, the CRB is underperforming the S&P 500. Here's an inverse showing how the S&P 500 is outperforming the CRB index. The NASDAQ 100 is just giving us a golden cross in this ratio, and it is now starting to outperform the S&P 500 as we've been seeing some strength in tech. Then some other stocks. Here's mega cap. These are the big companies, Microsoft, Apple, Google, the big names that you probably have all heard of. We've seen a recent golden cross, and that is new this week. The mega caps are also outperforming the equal weight S&P 500. Not enough yet to give us a golden cross, but showing a lot of improvement. The S&P 100 has been outperforming the S&P 500, but not enough to give us a golden cross. The small caps had a pretty good week last week, but they're still underperforming the S&P. We're seeing this really going down, even though it's still in an overall uptrend. We like to get support from the small caps, and that really helps the S&P to perform better. Small caps tend to be more risky. When people feel more confident with their current investments, they're willing to venture out and maybe splurge on some kind of a small company, hoping to buy low and sell much, much higher. With this breaking down, that's putting a headwind in front of the market. Low volatility stocks. This was pretty much the place to be in 2022. Didn't mean they stopped going down. They just went down less than some of the other stocks. We're seeing it pretty much chopping sideways here, and we're getting really close to a death cross for this ETF. Comparing low volatility stocks to the S&P, we're seeing a death cross now with this ratio showing that low volatility is coming out of favor. The Dow Jones Composite is still in an overall uptrend and had a good week this past week. Looking at Dow theory, we look for divergences, either positive or negative, where we were up with the Dow, up with the transports. Utilities are lagging a little bit. Now, I include utilities in Dow theory. Other people just look at the Dow and transports. We want to watch this utilities index to see if there's any real divergences. But then there's another chart that we look at where we want the S&P to outperform utilities that I'll show you in just a moment. Another way of looking at Dow theory is having the S&P on the top, and it's starting to break out above this line, but we are in a very overbought condition right now. Also on the bottom, the NASDAQ, which is a broader measure, is also showing a little bit of a breakout, but we could be due for a pullback since the market is so overextended to the upside. The FANG stocks, recent golden cross, showing a lot of improvement. ARK is still in an overall downtrend. It's been chopping sideways recently. Then we look at the S&P 500 and compare it to outside markets in Europe, Australia, Asia, and the Far East. We're still in an overall uptrend. We're above this red line. This is a monthly chart, so it takes a long time for these things to change. Down below is a momentum oscillator, the percentage price oscillator. It's still in an overall decline, but we maintain that positive stance as long as we're above this red line and it's turning back up. Eventually, we hope this PPO will also start to turn back up. Looking at bonds against stocks, bonds are still in an overall uptrend. We had a recent golden cross with the bond ETF. The world bonds are also chopping around quite a bit, but the blue line is still above the red line, so that's positive. Looking at stocks to bonds on a monthly ratio, stocks are still outperforming bonds, even though bonds have been pretty strong as of late. This is not really showing us too much. This is shorter maturity bonds where they tick down just a little bit as the market had a good week this past week. High yield corporate bonds are in an overall uptrend and starting to show some improvement. And the investment grade bonds are also looking better and are positive. Then we look at the stock to bond correlation. We're right in this neutral area right now. Getting back into March, we saw when stocks were going up, bonds were going down and vice versa. That relationship is starting to change. When we're above this red line and below this blue line, that means we're more neutral as the market could be shifting. Corporate bonds continue to be in an overall uptrend. The 10-year Treasury yield, after going way above over 4%, has now dropped down. We're at 3.494%. Here's another look at the 10-year yield. This is still another look at the 10-year yield, closing at 3.492. And here's the 30-year yield. After really spiking up, has been coming back down. Then comparing the S&P 500 to the rise in interest rates, the S&P is still underperforming, but we're seeing it start to show some strength. Junk bonds, which tend to follow the stock market, and these are higher yielding bonds, they are in an overall uptrend. And when we compare junk bonds to government bonds, junk bonds are outperforming, as they should, because they're giving more of a yield, but they also come at greater risk. Looking at bond prices, we're still in an overall uptrend with the MACD, but it's starting to roll over. On the top, we're positive with the RSI above 50 and advancing. And here's a look at the different Treasury yields going from the 30-year down to the 3-month, how they have been declining over the last few days. Internationally, this is a weekly chart where rates have gone back up in the US, the UK, and Germany. Down at the bottom, we have Japan, which is its own little story that we're keeping an eye on. Here's a chart looking at the ICE Bank of America US High Index Option Adjusted Spread. When this is going up, that's a little bit of a concern. It tends to go in the opposite direction of the S&P 500, so we're keeping an eye on that. The KST is positive and could be getting ready to roll over, so that could make things a little more friendly. Then looking at some different sectors, this is the other sector I was talking about. The S&P ratio to utilities. When the S&P is really going up strong, it will outperform utilities, and we're chopping sideways right now, so that's a little bit of a warning sign for the market. The staple sector is still in an uptrend, but getting close to giving us a death cross. And energy has been outperforming the S&P 500, even though it's shown some weakness. It had a good week this past week. The tech sector is in an overall uptrend, and semiconductors are also in an overall uptrend. The tech sector to the S&P 500, tech has really been doing well as of late. Then we look at the different sectors. Discretionary is still in an overall downtrend, but trying to bounce back up. The energy sector is still in an overall uptrend. Materials are in an uptrend. Financials, just getting hit by this whole banking crisis, is still continuing to show some weakness. Real estate has been underperforming, but bouncing back as of late. Utilities are also in an overall downtrend. Healthcare just crossed over with our ratio negative, and that is showing some weakness. Here's another look at the healthcare S&P ratio, where it's now looking weaker. Communication, which has been doing well lately, we have a recent golden cross in this ratio. Staples, we just have a recent death cross in this ratio where they held up a lot better in 2022. Industrials are in an overall uptrend. And the NASDAQ 100 to the S&P 500 is just giving us a golden cross with this ratio. The NASDAQ 100 is outperforming the rest of the NASDAQ and is in an overall uptrend. And then some other areas we look at, growth, which are growth stocks, compared to government bonds. We see that growth is making a comeback. Even though bonds have been doing well lately, growth has still been doing better. And then comparing the 10-year yield to the tech sector, just giving us a death cross with this ratio. Inverse of that same chart showing how we're just about ready to get a golden cross, where tech is now outperforming the rise in interest rates. Discretionary is still in an overall downtrend compared to staples, but it's showing a lot of improvement. Here's an inverse of that same chart. We could be getting ready to see a death cross with this ratio. Energy is giving us a death cross compared to tech. As tech is doing better, energy has been showing some weakness, where in 2022, energy was the star sector. Gold is still in an overall uptrend compared to the S&P. Gold is also doing well when compared to the US dollar. High leverage loans, these are risky loans, and if the economy was getting ready to fall apart, we would see this really collapsing. It's not. It's in an overall uptrend, and over the past week has shown a lot of improvement. Then our InterMarket Analysis chart going back to the beginning of 2022. Oil is still in the lead, followed by the dollar. Gold has been showing some improvement. Still negative going back that far are stocks and bonds, but both are starting to show some improvement. Looking at banks, which have been in the news lately, we're still seeing a lot of weakness in the bank ETF. Here's a regional bank ETF. Even though it bounced up on Friday, is still in an overall downtrend. Here's another regional banking ETF. And then we take a ratio of the regional banking ETF against the financial sector, and it continues to break down. First Republic, which has been in the news a lot lately, it was up a bit on Friday. Just a week or two ago was at around 115. Now it's trading at $13.99. We also keep an eye on the different yield curves. The 10 to the 2 is still inverted. We're below this red line. The 10 to the 3 month, that's also inverted. And these are the ones that economists pay most attention to. I also look at the 30 minus the 5 year, which has now gone back to being normal. And the 10 to the 5 year still remains inverted. The one on the bottom, I don't follow that much because the Fed funds rate is only updated once a month. So it's not really useful to us. Another new chart, which was inspired by watching a video by Schiff Capital. It's a YouTube video that I would highly recommend that you watch each week. This looks at the ratio between the 1 to 3 month T-bills, which is pretty much cash, and compares it to the tech sector. When this is going down, that means the tech sector is doing really well. When it spikes back up, that's usually times of trouble for the market. 2022 was very challenging, so this really spiked back up, but now it's starting to come back down, meaning that the tech sector is doing stronger when compared to the rise in interest rates or just holding cash. Another area we look at are some index comparisons. Here's the Amex, the NASDAQ, and the NYSE. We take a 5-period moving average of their highs minus the lows. They are still negative, so broader based. We're not seeing a lot of this strength yet. Small caps are still in an overall uptrend. Even though they saw some weakness, they have been bouncing back, but they have yet to recapture the 200-day moving average. The micro caps, which we started watching because they hit a new 52-week low very recently, they're also bouncing back up. This could be negative for the market if these stocks really start to break down. Another look at small caps is the Russell 2000 index, where we're showing some improvement with the RSI going above 50. The MACD has crossed over positive, and we've been bouncing up with price, but just as on the other chart, we're still below the 200-day moving average. And looking at the ratio between small caps and the S&P, it's really been breaking down. The small caps, based on the Elder Impulse system, have recently switched to positive. The mid caps also showing some improvement, and looking at them with the Elder Impulse system are also back to positive. The Dow was able to recoup its 50-period moving average and is showing some improvement. The diamonds on the Dow are back to positive. The NASDAQ, recent golden cross, trying to break out, but looking at some potential resistance at a previous high, where NASDAQ, based on Fibonacci levels, we never did get back up to this 38.2% retracement. We're going back and retesting this high now. Can we break above that, or are we going to fall back down as the market is overextended to the upside? The NASDAQ 100 also showing some strength, broke previous highs. We still have some overhead resistance above current price, and we're also positive with the Elder Impulse system. This did get up to the 38.2% retracement, and then we fell back from there. We broke above that. Now we have some more resistance at the 50% retracement. Can the NASDAQ 100 continue to go, or are we going to pull back first? NYSE, recent golden cross, showing some weakness and has been bouncing back. The Wilshire, also showing some improvement after going positive. All stocks, recent golden cross, showing improvement. Emerging markets, recent golden cross, improvement. Internationally, China's turning up, emerging markets are turning back up. Europe, Japan, and the US have stronger looking markets based on the KST. Bitcoin, having a recent golden cross, has been showing some strength. Then some different correlations. This is S&P to the dollar, just about at the neutral point right now. S&P to oil, where they're having a tendency to go in the same overall direction. As stocks are going up, oil is also going up. And S&P to the 10-year yield, coming back down, but having a slight tendency to go in the same direction. Tech sector to the 10-year yield is now neutral. And then the S&P to the 2-year yield shows that they're having a tendency to go in the same direction, but that's weakening slightly. Then the home builders, keeping an eye on this. The S&P has been going up. The home builders have been going up, but the ratio between the two is not showing a lot of strength right now. So when we look at the bottom, the correlation is really breaking down. If you look at other times when we saw a really low reading, that often marked a top in the S&P. So we're keeping an eye on that one. Then another long-term study, we look at the NYSE monthly chart and show that the Copic curve is pretty much flat right now, and the NYSE is just slightly below its moving average. So it's improving, but it's still negative overall. Then also with the NYSE composite, the NYSE record high percent index, after really coming back up, has been falling down, but it has bounced recently. And then the S&P to the PPO is turning back positive, so longer term that is positive on the monthly chart. Comparing the S&P 500 to the CRB, the S&P is starting to outperform like we've seen in other charts, but this is a longer term chart. And then the S&P to global stocks, we're still seeing some weakness with the KST, but we continue to be above this moving average. Also a monthly chart of the S&P showing how the CRB is breaking down when compared to bonds. Here's an inverse of that same chart showing that bonds are giving us some strength. Here's the CRB, which is starting to roll over on the top and also rolling over when compared to bonds. And another ratio showing how bonds are now outperforming the CRB index. Looking at the ratio on a weekly basis, the KST is showing some improvement, giving the edge to bonds. And also in the intermediate term, bonds are starting to outperform the CRB index. An update of a few of our charts. The S&P 500 stocks above their 50-period moving average is improving, but with the strength that we saw in price, we want to see more of a broad-based participation when the market's really going up, and we would expect this to be a lot higher than it is. And the same thing is true with the mid-caps. It is improving, but we want this to be up higher. And then the small caps also showing some improvement, but we want it to be higher. So what is positive right now? This is when we take a 50-period simple moving average, and if it's above the 200-day simple moving average, that is considered positive. The value indexes and ETFs, the dynamic software index, those are the really big software companies. The euro, the Japanese yen, and the British pound compared to the dollar, copper, gold, and silver, mega caps, which is a new addition, the low volatility ETF, the Dow Jones Composite Average, the FANG Index, all the different bonds that we look at, the ETF, the high yield bonds, investment grade bonds, world bonds, corporate bonds, and junk bonds. Staples are showing some weakness, but still positive. The tech sector and semiconductors, high leverage loans, as well as microcaps, small caps, mid caps, and the Dow, the NASDAQ and the NASDAQ 100, the NYSE composite and the Wilshire, all stocks, which takes global stocks into consideration, emerging markets, and Bitcoin, believe it or not. What is negative? When the 50-period simple moving average is below the 200-day simple moving average, growth, even though it's showing improvement, is still negative. The CRB index is negative, the dollar is negative, and ARK continues to be negative. Thank you. I hope you found this helpful. Please feel free to check out the daily video that I posted for Monday. Also, I have a weekly video. After this, I'll be preparing what I call the deep dive video, where I go through a lot of the different charts that I didn't use in the videos this past week and make a separate video to get some insight from that. I hope you have a really good day, and I will talk to you in the next video.